Welcome, everyone. I'm Angelo Robles, host of the Angelo Robles Podcast. I'm also the founder and CEO at Family Office Association. I'm so fortunate to have amazing discussions with great thinkers and thought leaders. And to give you a little bit of context of our discussions, I help global families and their family offices solve problems, procure positive future outcomes, and prepare for intergenerational necessity. It's vital for families and their family offices to understand their vulnerabilities and become more resilient so they can mitigate risk and prevail during times of crisis. Our special topic today is why and how your family office should create an internal VC firm. Now, that title could be a little bit provocative. It's meant to spark discussion. And for many investors, and I think our guest will agree, it probably is better off being an LP. But for some substantial families, there are going to be some advantages. So if you're going to do it, understand it and do it right. Our special guest today is Jeff Stevens, co-founder and managing partner of Infusion 51A. Let me read a little bit of his bio. As noted, he's the co-founder and managing partner of Infusion 51A LP, International Infusion Holdings LLC, and International Infusing Advisors LLC. With an emphasis on the global market, he uses key positioning and strategies to identify investment vehicles that meet the investment advisor's proprietary investment parameters. He currently serves as the managing partner of International Infusion, a think tank venture capitalist firm aimed directly at disruptive technologies. Jeff, it's a pleasure to have you on the show.
Thank you, Angelo, and hello, everybody. Thanks for allowing me to get on here and speak with everybody.
Well, this is such an engaging topic for me. Many of my families know, as I've had more time during COVID, maybe too much time at home, to really think and come up with a lot of unique, I think, somewhat proprietary ideas for successful families. Many of my families have heard about U.S. families needing to be more international, possibly offshore structures and family offices, buying banks in Switzerland, Bitcoin, PPLI, offshore insurance companies. And among other things that I'm starting to hear are for some families creating their own internal VC. Now, some of them end up converting that to a commercial enterprise as a GPLP. We may get a little bit into that, but for the most part, it's going to mean the why and how and the advantages and disadvantages of potentially doing very hard investing. The professionals often fail and doing it internally. So, Jeff, in setting the stage a little bit, many families are intrigued to be an early stage investor. They want to have their ear to the grindstone of the latest deep tech and technologies. They want to discover the next Uber and next Google, as if that's easy. Now, what's the advantage is if they're right, if they make enough diversified investments with a little bit of strategy, a little bit of luck, they might be able to get that. I think the pros, it's about 1 in 117, get that unicorn. And if you're really, really early, depending on dilution and other valuations, you may do incredibly well. Now, I'll often hear families say, well, later stage, it's safer. Absolutely. When a company is showing great promise, their valuation is going to skyrocket. You're going to get in. You're more likely to be successful, but you're not going to get that crazy exponential return, more than likely, because you're playing it somewhat safer, which is probably what most families should do. I'm not discounting that, but there still is the gravitas and the appeal of getting in early. Talk a little bit about that synopsis of being an early stage investor from theoretically a non-professional, a family office perspective.
Yeah, so I think that the first thing that, at least on our side, what we look at is identifying what does it mean to get in early. And so there are definitely emerging ideas with disruptive technology where people are starting from ground zero, create an opportunity, obviously, to invest and be one of the early adopters and really drive value that way. For us, what we look for is a little bit different. We look at companies that might be a little bit further down the line, but for some reason had a reset, or they need to have a reset. So that creates an opportunity for us where we're actually accumulating more information. We're creating more data that we're able to assess the opportunity, yet give us that still same VC type mentality where we're coming in, we're doing some of that heavy lifting, we're putting some of that capital to work on that reset, and taking advantage of that from a alpha perspective where we're still early adopters. We are putting that process together from a capitalization standpoint and structure, which is extremely important because when you are investing early, whether it's right at the very beginning or whether it's a restart early, that there's going to be some pretty good capital needs to go from A to get to a valuation standpoint where you can actually exit. And so creating that strategy on the front side where how a company can capitalize all the way through, and you can kind of control the dilution, and what I call it is value-based dilution, so that you're making sure that you're hitting milestones that can actually hit value for you and for your investors is extremely important. So that VC type model is more in the niche where we're trying to really play in, rather than just coming on an early concept. We're always still looking from an early concept type stage, but you would be surprised how many early type concepts are emerging, especially like with what we're doing in precision-based healthcare, that still have a lot of data, a lot of evolution, a lot of years getting to the point where it actually can launch and start growing.
I mean, I had the legendary early investor, Jason Calacanis, on multiple times, but the last time this early summer, he basically said that some early stage entrepreneurs think of family office money as a direct investor. And he meant this a little tongue in cheek, but a little bit of grain of truth to him, as being kind of stupid money. And I asked him to explain, and he said, listen, if you're an entrepreneur, I don't know, coming out of Y Combinator, someone who has a really great idea, you have interest in other earlier stage VC companies, why are you going to go with the family office that is maybe not going to have the bench depth, the other aspects to helping you grow with mentorship, potentially bringing in other VCs? Now, I don't necessarily completely agree with that, but there certainly is some truth to that. So if you're going to be a single family office looking to be very internal with your direct investing, whether dozens or hundreds of investments, we'll get to sourcing in a little while. But for competitive early stage deals, how do you compete with the professionals?
Well, I think that whenever we look at a deal, we want to go back to fundamentals, right? From a fundamental perspective, the best deals that we find normally are easy concepts. They're A to B to C to D, so you're following a pathway. So the frontline due diligence is obviously extremely important when you're vetting a deal. Vetting management is extremely important. So we'll go in, we'll actually look at the actual concept itself first, right? If the concept makes sense, we'll pass it through experts within our field. So as you're laying this out on, okay, we're looking at potentially putting a VC, arm to our family office. These are some of the things that you'd be looking to do is how are you going to vet your deals, right? Second thing is once you do vet your deals and you say there's viability here, who are some real trusted advisors that you can go out that potentially either will utilize the tech or utilize the concept and get some feedback there. Then we're doing a little bit of back-end research on the total addressable markets. And the cool thing about this is it sounds like, oh man, there's so many different moving parts, but there are some very good technologies out there that give you access to doing a lot of due diligence and homework, right? As you're understanding that, I'm just talking, that's on the inside stuff on what we're doing. And then you're narrowing that scope down into some viability that you actually want to move forward with. The next thing that I think is extremely important is to go out and do what's called asset mapping, right? So whenever we're sitting down with an executive or we're sitting down with a team, we're going to go out and we're going to look at not only the idea, but what are the assets that they have to make that that idea work, right? What is their depth? What is their structure that is set up from a finance side, from their executive experience, whether it is, a private company or a public company. What are all the tools and the resources that they have, right? If you understand the assets that an organization has to offer, then you can start strategizing where you guys can come in. And this, the second phase is, which is the need assessment, right? From a need assessment standpoint, now that we know what they're able to bring to the table, we're looking at the deficiencies, and then we're also internalizing where we are and where we can add value to the investments that we're making, right? So we can take some of the processes over that are some of the mundane internally, and we're able to control some of that. There's obviously cost benefits from an efficiency standpoint because we're bringing it in. We're also able to offset some of our own internal costs as well, because now we have some advisory capacities that we're, assisting some of these companies in. And most importantly is we're really pristinely looking at the operations of the investment that we're making. So we're able to help control some of that, which ends up giving us tighter reins of the ship, making sure that there's accountability from a finance spending perspective. And then after that, that we're in place with operations. And then the last thing I think is extremely important is really be very active in the board structure of the businesses that you're investing in, if at all possible. So what we really want to make sure is people can highlight different individuals that are on their board that are so quote unquote advisors. But if those board members really are not active inside of it, then what real value is they're being bringing. On our side, if we have great relationships with a board that we can also help adopt inside of a business, that we look for board members that will actually invest as well. So they're placing their own capital inside of the company that they're advising on, which I think is extremely important in order to line up everybody's initiatives. And then the second thing is making sure that we're really getting value from the board members. I'd rather have somebody that is more moderate in terms of experience that's going to add a lot of value than somebody that's a really big name but never is going to really help from that perspective. And as you're looking at the VC end, I think looking at those branches that's really going to take in order to make a company functional and actually drive value is really some of the things whenever you're looking at maybe starting that arm, is to see what you guys have to offer in terms of some of these little branches. And then the second thing is, if you don't have all the structures in place, where are some places that you can lean into that you can get some access to some of these structures?
That was a very comprehensive answer. And for, I would say, companies showing some traction, getting active on the board, engaging with other board members that you bring on is likely a good strategy. It's harder early stage when you're doing a little bit of the spray and pray, which to some degree you almost have to. I don't think we have Dave McClure on now, who's a personal member, but for those of you that don't know, he's the founder of 500 Startups. Should have been called 1,200 Startups, because I believe prior to him leaving, he was active in 1,200 startups. You did mention something that's of interest to me. You mentioned certain tech and online resources to greater vet and due diligence. Would you mind sharing, maybe if I'm a family creating an internal VC vehicle and I want to be active in that, what are some resources they could use from a technological perspective?
Yeah, so I think first off is your internal operations. From an internal operations standpoint, we're using Zoho One inside of what we're doing. And so that's kind of cool because it has like your CRM system, your sales system, your marketing system. It has your finance system that you're able to tie that into as well. And then more importantly for us, a platform like that gives us accessibility in terms of our portfolio companies as well. So if we're doing a portfolio company where we are very active in leadership and management and pointing people in that place, having them through the same processes and premises is absolutely essential so that you're able to fluidly help monitor and then also drive down cost So Zoho One is one platform. The other thing that I think is extremely important in terms of some of these type of outfits is not just having the resources itself, but also having the ability to analyze the data behind the resources. So the artificial intelligence perspective. There's a saying that we live by is if you can't measure it, you can't manage it. So I think that as you're setting up some of these structures and some of these resources, having a game plan, and you'd be surprised, is not as complicated as it seems. Where you can actually get some really good, talented individuals that are dropping analytical tools behind what you're doing, right? And this isn't just for website monitoring. This isn't just for traffic, but this is also for deep dive due diligence that you're planning on, how you're going to access that data, and then more importantly is how are you going to monitor the changes, right? Artificial intelligence gives a really good vehicle that you're able to start populating so that you can manage tons of data and really understand if other investors are coming in, to what other companies and what other timeframes and how much are they coming in. And then you can grade the investors so that you're looking at A-level investors to F-level investors that might be good short opportunities or might be good ways to hedge against. And so that analytical aspect I think is essential in driving the second type of architect. And then there's just tons of different service providers that have industry reports that you're able to tie in. There's also really good access to analysts that you can do some real easy analytics on, in terms of having like 2, 3, 4 different analysts that you can pay nominal amount of fees to see if they're coming back with some of the same viewpoints that you're coming back with, which I think is extremely important. And so it's really getting as much intel and insight, put it in a measurable standpoint with artificial intelligence or any of these other different ways, so that you can access that data and then you can make better decisions that way.
Yeah, I mean, Peter Drucker's quote about you can't improve what you can't measure, and I believe back in the 40s that comes from him, is every bit as applicable now, which is why I quote Peter so much, what a legendary figure. Many families are considering being more hands-on as effectively their own internal VC, partially because access to some of the top 10 or 15 VCs is very hard, even for billion-dollar families that have people that keep on re-upping as LPs, have significant institutional investors. That's not to say that other than the top 10 or 15 are not good. Many of them are great, but a lot of the families may initially want to get into the big ones, and that's very hard. So potentially looking at doing it internally is going to be intriguing. We're going to circle back to what you said about people, because it is going to come back to hires, arguably being the most important fact. But I would like to give a little homage to someone who is on the live Zoom now. We had her as a guest a couple of months ago, Christy Kiegler at Vernal Point, who talks about in the research that she's done, why would families want to do this? Because it might be even net better to just be a 2 and 20 investor as an LP. But there are certain reasons why. And the big one is families like control. They might be willing to accept that their net at the end of the day may be about the same as if they were an LP, but they don't feel like they're in a position of control. We could argue that, but that's going to be an important aspect for some families. Some may want to engage the next generation that may be tech savvy and may want to be involved in something like this. And investing, whether as an LP or in public stocks, although I think it's kind of engaging, it's not teaching you how businesses work. You're going to get your hands much more dirty being active as a direct investor, and that could be very valuable for people. Let's go back a little bit to what you said, Jeff, because I've been talking about it's always people, systems, and technology is probably the big 1, 2, and 3. And I think in doing your own internal VC, that is going to apply to that as well. So when I talk to professionals in the community, here's where they say most families go wrong once they're committed to doing something like this. They try to do it with the family that may not have the experiences. They need to bring in outside talent. How do they source that talent? I think they should probably go through a VC recruiter, but they may know an up and coming analyst in a VC fund that may be willing, if they get a piece of the action, to come on board to what the family's doing and creating something. Would you say that making the right outside family hires may be among the most important aspects, and how could they go about that?
Yeah, I think hiring is extremely important, and I'm trying to figure out how to say this without sounding not nice, but it's also not about just who you hire, it's about who you don't fire, right? For me, what that means, obviously you want to try to build the best team, and having very low attrition is ideal. And on our side, we want people that are going to be with us for 30 years. And we love that. We love people that are coming in and hiring great, but understanding that in this process, there is no perfect path at all, right? And there's going to be mistakes that are going to be made inside of any business, inside of any investment. And so understanding that, trying to really narrow down exactly what you're trying to hire for. And then if for some reason, if the individuals are not, fulfilling the concepts that you guys are trying to develop and the principles that you were trying to develop, it's better, in my opinion, to move on sooner than later, and then focus on the ones that you are. When we're looking at people, we call it always be recruiting at all times, right? So whether I'm downtown on an elevator, or if I'm in San Francisco, or everybody's always passing out different business cards. And at the end of the day, like, people are stuck with stacks of business cards, and they're like, all right, well, it's great that I have all these cards, but how do I, translate this into actual good hires and whatnot? And that goes back again to the artificial intelligence, plugging those individuals in an accessible database, prioritizing people that really blow you away in terms of, their concepts or ideas. And then put in a communication strategy that you're always staying in touch with these individuals. So what that does is you're evolving that inner circle, and you're growing that inner circle, and you're keeping that depth. And you just put something on your calendar, even if it's for 6 months from then, or a year down the road, where you are touching base, and you're actually putting good notes and systems that are in place that are going to really trigger conversations, and you're building rapport with these individuals. Which brings me to, when hiring, for us, I think the first place to always start is in your network, right? And if you're building out that strong network, I think that's great. The second thing is making sure that you have real good mentorship and leaders and advisors that you can go to, and so that you can avoid some of the mistakes in terms of bringing on the wrong people and figuring out who do they know, right? I think those are the first steps that we're always looking at. So we're growing our bench, we're going into our network, we're trying to really grow and utilize that. And then, lastly, I think, is sourcing, whether you're using a recruiter, whether you're calling even some of your competitors. You'd be surprised how many competitors definitely have a real good philosophy in terms of sharing and asset utilizing together. And by going down that path, you can get a lot of really good talent just by picking up the phone and calling some individuals, right? But I think people are absolutely key in terms of creating that atmosphere, and then also implementing the ideas and processes, and actually making sure that everybody's vision is in line.
Now, there are some challenges, I think, from my experiences, that most families will face. One, some professionals in the community are not going to be sure about the long-term commitment of a family. How much money are they willing to allocate? Is it going to be 50 to 100 million? That starts to get some attention. How committed are you? How knowledgeable are they? A little bit like a sports team owner. Are they going to be involved? And that's kind of good. But are they going to know to let the general manager and coach do their thing without too much interference, just some broad help and direction? And I mean, here's a big one. Let's be honest. If someone's a partner in a VC firm, they're probably not going to walk away from what they've built up in carry and relationships from an existing firm, your offer would have to be off the charts. So you're probably going to be hiring a notch below that, someone a little younger who's up and coming. But why? Why should they leave where they are now? They're probably in a pretty good spot if they're up and coming. You're going to have to make it attractive to them, which is why at the end of the day, don't think that going this route and avoiding 2 and 20 through funds is going to make a net difference. You might even make less money because the investments aren't as good. You're doing this mainly for other purposes like control and engagement with the family, the company. And those in the family office world kind of know what I'm talking about. But when it comes to net pure investment, you probably will not be as good as the professionals once we're adding everything up here. And the fact that for you to recruit people and need to pay them a carry and need to commit to them and have contracts, I mean, do you really find, Jeff, that most families really have the stomach or dedication or knowledge that all they're going to have to do to create this internally? It's damn hard.
It's hard, but I mean, the first thing is to ask the simple question is why, right? Why are we even considering going into this realm? And as you understand why, then the second thing is the how, right? How are we going to go through this? And if the why is good enough and the how is clear enough, is doable. It's definitely doable, right? I mean, I think that obviously doing fund investing is definitely a concept that makes sense, and you can, mitigate risk by investments through a lot of different funds. You can do some pretty good homework that way, and I think that is definitely viable. The other thing is like part of the how is, even though it sounds like this magical, complex type structure, it is not as hard as you would think. Like just a simple little tip in terms of this is I would look at some of various VCs that are doing it and doing it well. And then I would look for the people that have advisory capacity as well, because most of them build out their advisory capacity separate from the actual VC entity. And then if they have an advisory capacity, it might be something worth talking about potentially white labeling. So yeah, can you go out and get, a COO of a, prominent VC type firm, that's cost effective and that makes sense. And if they're doing something really well, why would they leave? And really doing that recruitment process, that's a strategy. But another strategy that you can really look at is adopting their advisory capacities, white labeling that, and let them take control of some of those operational roadblocks that you guys aren't really built for, right? So that's just different ways that you can do out of the box thinking and tackle it. But again, hammering the first point is really understanding why. Is it really you're chasing alpha? Is there a better way that we can chase alpha, that we're blending it, right? How much money are we allocating is really creating a model. And then if we allocate X amount of money, what with those positions and investments from a VC capacity, do we want to be hands-on? And then what are some of the percentages maybe that we can invest from a side, right? So that you can mitigate risk and control, and so those all tie into some of the hows, some of the whys. And then if you come to the standpoint is, what, we really like this, we really want to be involved. The how is just structural, just trying to figure out ways that you can leverage and grow and build.
Kudos to you, Jeff. For someone who has a fund, you're actually probably more on board with families being more active, direct. You think from what I talk about in my title that I would be, and I am, but I think for 5 to 10% of the families. I think, again, I'm going to say most families that want access to this asset class are probably better off being LP investors. And there's nothing wrong with that. You're probably going to do just as good or better without having the headaches. You really need to make it a long-term commitment.
I think that right there, Angelo is right. That's the word. That is the absolute word, commitment, right? Once you know the how and you know the why, and if it's a go, you got to make sure that you're lacing that commitment in, because like we said, there is no perfect investment. And once you have a team and you really are driving that commitment and you guys know you're going to do everything it takes to make it work, then I think that's really the missing link. That commitment, I think, is everything.
Yeah, I mean, you have to look at it from a family side. Don't just do it haphazard or don't do it at all. What's your vision? What's your mission? defining your purpose, putting your goals on paper, having effectively a business plan. Treat it like a business. And if you don't, it's going to be hard enough to be successful anyway. But if you don't do any of that, then it has no chance to ever get off the ground.
Yeah.
Okay, there is an elephant in the room relative to this topic that we haven't spoken about yet. We might have hinted a little bit around it. Okay, I have the purpose, the vision, the mission. We're going to put $50 to $100 million into earlier stage direct investing. That's just as much or more than relatively small to modest size VC startups. We have connections. We have the right legal structure. We didn't even get into that, but of course, you should do the right legal firm, know where you're domiciling, have the right structures, know how to set it up. I think that goes without saying, but I'll mention it. But here's the big one. How are you going to source quality deals, and how the hell are you going to do a better job than the thousands of professionals that are out there? So when I spoke to families and some professionals, here's some of the things I heard. It's easier than ever because of online and a global community. Could you get into Y Combinator? Maybe if you come waving the fact that you're going to be throwing around 100 million, maybe if you have a connection. How could you get into other accelerators? Should you start an accelerator? Do you go to college networks? So I'm going to ask you, Jeff, as opposed to giving you all these great ideas that you're going to do a much deeper dive than me. How are you really going to source quality deal flow against the professionals? Come on, it's hard.
Yeah, it's not easy, but it's not really that complex as well. Again, I'm going back to the artificial intelligence data. So deal flow, it's just like overload, right? If somebody goes into a store and there's 3 objects on the wall to buy, they're able to make a decision. You go into a store and there's 500 objects on the wall, right? You might be in there for a minute because you're picking everything up and you're looking at it, right? So really data sourcing, indexing, and then monitoring as well, I think is extremely important. Outside of that, even before we even get there, I mean, for me, we're investing within a niche of a niche of a niche, right? So I know that everybody, I mean, you can take some of the generalities of what I'm talking about and apply to whatever niches you guys are interested in looking at. We're looking at upcoming waves and trends, and we're trying to get on the front side of those waves, right? And for us, what we've identified is precision healthcare as an emerging wave. We think that there is a lot of value within precision healthcare. And what we really like about precision healthcare is that you're able to gain a lot of actual quantitative data utilizing some of this technology, right? So the better quantitative data that we're getting, the more accurate our decision making is in terms of the investment selections that we're looking at, right? So we have a little bit of what I call an edge in terms of selection of what assets that you're going to go after and how you're going to source deals. The next thing that we're looking at within our precision-based edge is who are the players, what universities are actually contributing to some of these techs that are evolving. So if you're looking at some frontline due diligence, like foundation medicine, you're looking at like NanoString, you're looking at exact science, and you beg the question of where do some of these technologies come from? And then, I had I guess I was a little lucky in talking to the guy that developed the Cologuard for Exact Science and was able to offload it to them, which was great. But more importantly, when you start looking at that, you're able to see what labs are coming out of and some of the advisors that you're able to talk to. And then it was actually happened to us by chance, but we were out there, and one of the things that we think is extremely important for us internally is really preparing not just our fund, but the investment that we're making in the companies to get ready for an exit very early on. So that means, having people that are following the story from square one, from day one, whether it's a 2, 3, 4, 5-year cycle, you're accumulating a lot of those people. And so part of what we were doing is we went out there and we did, an email campaign where we're informing people of what we're doing. And we're targeting a lot of the medical community for a deal that we were doing. And as we did that, the oddest thing that came back was we populated, I think, 18,000 names, various physicians, most of them from academic universities and whatnot. And we went out and we rolled that out. I got so many emails about, hey, we have a lab here and we developed this and we developed that and we have a really cool concept. And so it's not exactly as traditional in terms of going and looking at, very active leadership that are out there trying to really build out their brand and their business, but actually going to the thought leaders and the KOLs, and how that kind of emerged was really fascinating to me, and that was a really good access to understanding what's going on there. So understanding your niche, utilizing some of those tools, accessing and indexing that data, and then the most important is go to the people that have already done it and have been there. Talk to them, see what deals that they have on their table. Like some of our mentors have built some billion-dollar companies, public companies, and as you can imagine, they're getting bombarded with different ideas and different capacities. And for us, we went to one of them and we were talking to him and we were like, hey, if you have some really good businesses that you think make sense, because for him, he's like, I really don't want to go out there and have the headache of running 5, 6 more, 7 more different businesses. We're like, hey, well, we'll sign up for that. We love that idea, right? If you can come in and give us some governance and some supervision in terms of some of the expertise that you've already done this, and you can add benefit that way, we're able to come in behind and actually put some of that manpower behind what some of these concepts are and do some of that heavy lifting for you. And I think that was a model that worked really, really well for us, is going out to the people that have already been extremely successful, talking to them, talking to what businesses or ideas that they seen come across their table that they really like, but they just didn't have that motivation because of their already previous success to implement, and work something out with them where, they're going to give a little bit of oversight and you guys are going to do a little bit of the groundwork. And that turned into, for us on our side, we have deal overflow where we're selecting. And then also, like you were just talking about, putting together demo days and something like that. I think that's something that can definitely be done as a division within the division. So if you're starting a VC type channel and you're getting some, whether it's some internships or some of those new executives and they're showing a little bit of initiative and they're being somewhat successful, right? Go ahead and take a shot, allocate 5% of those resources, do a demo day, attract some different ideas where people are coming to you and sourcing. And then also, as obvious, promote, making sure people are aware of who you are and what you're doing. And you had also mentioned this as well, as some of the incubators are definitely good to tie into. In Chicago, there's Matter. And they're always having keynotes that are coming in and speaking in different events, at least pre-COVID. Now everything seems to be digital. Talking to some of those individuals and deal flow is really great. But at the end of the day, it's really indexing and monitoring.
Well, you definitely shared some great insight. And yeah, one of the secrets that families could do that you noted is, identify their sector and their region, what universities may be active in that space, what divisions and professors could you potentially make a donation? Could you get active in the university? Could you get some of those professors on a board? Could they get in a paid advisory position? And how you could help to get access?
Angelo, check this out. This is how we did this, which is crazy for us. We're like, all right, how are we going to go about this? Because here's the thing is everybody always loves shortcuts, right? They're like, if I can grab, and you're always getting these, hey, we'll put you out on every platform really fast and, just subscribe for $2,000 and you're going to be on the Wall Street Journal and all this stuff. And or you're buying different lists and all this. And then we had this idea, which was insane. Instead of trying to find a shortcut, how can we just do the heavy work, right? The answer for us was, all right, well, there's some really good resources offshore, right, that we could tie into that was very cost effective. So we did a lot of data scrapping that was very specific. So rather than buying out information, at pricing that you're really getting things that have been regurgitated, is we really isolated exactly what we wanted to accomplish. We went out there at a very, very affordable price, brought on a team of 5 individuals, data scrapped it, right? And then carved out that message and then shot that out. And like I told you, I think out of those 18,000 people that we had data scrapped off of and shot out, and we were just really trying to get eyes on an investment that we're doing, we got back at least 200 messages from people that were like, hey, I'm a physician, I have this lab, I got this grant money from the NIH, we discovered this molecule, we're developing this AI type system, right? Can you help me? And so for very cost effective type ways, it's not as difficult as you would think.
Yeah, I mean, people probably expected me to be the one of the extreme advocate on the direct investing, and I'm probably the more conservative one. And you're giving away all the secrets, Jeff. Good for you. I was going to bring that up, especially in today's COVID, more digital, remote world. You're not limited to your town, your community, your region of the country, your country. You have the world as your oyster, and wages and opportunities are less efficient internationally. It creates more opportunity for wealthy American families to potentially onboard or outsource in Southeast Asia and Eastern Europe, wonderfully talented people at a much, much lower cost and potentially accessed again to deal flow and opportunity. And there are some VCs that have been successful at that, but most of them tend to be a little bit insular to the worlds of Silicon Valley, New York, et cetera. So you're correct. That is really bootstrapping it and getting really nitty gritty on it. Now, there are other techniques. If you're a legal and accounting firm, hey, we're forming this new VC. We're using you guys as you represent entrepreneurs. I mean, we may be very quick, aggressive capital. Maybe an advantage we have over some VC firms. Maybe we'll make a decision in 48 hours. I mean, we have the money. We're ready to rock. We're not saying we need to be the only early investor in, and maybe we're not going to be the most strategic or mentorship, but money does matter, and we're going to move really quickly. Understanding most won't work out, and you have to accept the fact of goose egg, single, and then maybe eventually you hope a little bit of lucky, quote unquote, that grand slam. Now, there are some other things. There's AngelList and other platforms now that arguably you could form syndicates and make it easier. And there is a very well-known organization among family offices, a group like Iconic out of Silicon Valley with Devesh and Mike Anders and those guys. Now, you may need to go in there waving a hell of a lot of money, maybe $100 million or more, but they're going to have a wonderful deal network of opportunities, maybe not as much early stage. So, there are ways that you could get involved directly with companies. I'll ask you about one. It's probably the most classic, is become an LP, become a good LP, and get opportunity for SPVs and access that may come up from the GP and the fund.
Yeah, I mean, I want to touch on something you just said. I'll get there in a second, but on becoming an LP, no, absolutely. I think it's extremely important. Also, here's a little tip. Like if I was looking at becoming an LP of a VC type arm, fund or whatever, private equity fund that does VC, kind of like some of the things that we do, right? One of the things that I would really want to know is if I was able to invest into whether it's a sidecar type investment or whether it's something more private or VC oriented or the overall fund itself, is there going to be an opportunity on that next raise inside of the portfolio companies where we can do a direct investment and lead around, right? So that's a really good way that you're structuring and hedging against dilution, and you're also setting the stage for yourself to be an early fund adopter, but still have direct access to some of the portfolio companies that are going to work out or that are looking really strong, post your initial investment. And so you can kind of hand select from there if you get a really good rapport and relationship with some of these VCs. And the good thing about this is from the VC world, whenever you're making some of these investments, that there's going to be follow-on rounds, there's going to be dilution.
For sure.
So if you're lining up capital partners on the front side, that might be some of your LPs that can go directly into portfolio companies, and you're developing that rapport and you're watching and tracking some of those internal portfolio companies with inside of the fund, then you really are putting yourself up maybe where, you might have to lay a lot of bets, but now we can narrow that down where we lay some really good front side bets. but then we're not laying another 20 bets on round number 2, but we're laying 3 directly in that have a little bit better proof of concept, that are a little bit more incubated, that are further along, and then you can really swing. The other thing that I want to narrow down, and something that you were just saying, is talking about, you need to come in with $100 million. I remember going out to JP Morgan early on in January, and it's just crazy from a conference standpoint. You're not showing up with $100 million. You're not getting in, right? And you're like, well, that's kind of frustrating. How do we get into a place where we have deal access to some of the players within this space? And not everybody's going to want to allocate 100, 2, 3, 4, 5, and $100 million inside of this. I think personally, we backed up way back up, and we were like, how can we leverage a little bit of money first, right? And then grow, right? And instead of, I think that a lot of times we get stuck on numbers. There's funds that are like, we're not allocating unless it's, minimum of 5 million to 20 million. And you guys have to be over 500 million AUM or a billion AUM, right? And then I'm like sitting here, I'm like, why? If we're able to target isolated businesses that are already created a little bit of that proof of concept, that is a little bit further along, and then we're able to go in for a smaller amount of capital, take control, clean up any of the outstanding issues that they have, whether it's convertible debt, bad debt, bad management, whatever it is, as long as the idea has value behind it, apply some of that smaller base capital, move it along so that we can increase in value, and then we can apply a little bit more of the larger type rounds. You can actually gain a lot of value for less money, which lowers your risk, and still have, especially in precision healthcare, that ability to really grow to $1 billion plus in market cap or company value, right? So I think I don't like getting fixated that we have to be playing with large amount of money to accomplish our goals. I understand, especially from a family office type standpoint, if you're managing, 100 million, 500 million, $1 billion, placing a $2 million bet, how many of them can you actually do where you can keep track of and you can monitor? But if you're smart about where you're placing that capital, you can really put yourself to grow where you can still hit your financial objectives with lower risk. So I think that's extremely important to look at.
I talk a little bit from the side of a family being active directly in earlier or even early mid-stage companies. The fact that their negotiation, their legal team is going to be important too. Meaning, do they have pro rata rights? Do they have the opportunity to invest in the next round? How are they going to get diluted? Could they at least invest in the next round at the valuation, but at least they have a first right of refusal? How important would all of that be? To me, that would be extremely important, because if they're starting to go to the next round, they're having levels of success that you probably want to tag on to, but I'll let you answer.
Yeah, I mean, it's great because we've all, I'm assuming everybody on here has probably read enough contracts by now, and legal has put together enough where you're seeing all the different bells and whistles. I think it's extremely important to try again to plan from A to Z. So how does a company go from where they're at when you get in to that exit point, right? How much capital is going to be required, and then road mapping a realistic plan where what we call value-based solution, and setting that in, right? And I think that when you're selecting any type of investment, understanding not just the capital that you're placing in now, but what that follow along round will look like, making sure that it's matching that plan. And then you're also on fire money just in case things don't go the right way. What's your bailout or how can you, go against that, whether you're going to apply more capital and take control, or if you're going to come in and take control of leadership and really protect yourself that way. These are really good little things in terms of understanding, but from a rounds rights, I think it's great to be able to put some of those in place, but you have to be very careful as well, right? You don't want to put handcuffs on a company that's going to make where some of the higher grade institutions that are going to come in actually not want to come in. So I think that's extremely important. And then the other thing is communication is a great way to go. So if you're going into a round, knowing the other investors obviously is important, talking to them and trying to collaborate in terms of the same like-minded goal, which is how can we get behind this company and support them and get them to a launch, right? Valuation is extremely important for us. A lot of people like to value top heavy, which puts a lot of pressure on everybody. In order to try to grow to that value and actually, either exit or raise money at or above where you just place your capital in. We like to do the opposite strategy. We look at companies that we think have a lot of value. We undervalue them. We create and we benchmark not just where we're investing in, but the next 2 to 3 rounds. And we try to plan a strategy around that value creation 2, 3, 4 rounds down the road, and understanding exactly what those milestones are, and really understanding that we have a really good shot at hitting those milestones. So value-based solution, I think, is extremely important. Planning for that capital allocation is extremely important. These are all great tools.
Great advice. There is another way to go about this that's a little bit of a compromise between solely being an LP and doing quote unquote your own thing. And a wealthy family, a single family office could seed a talented up and coming analyst that kind of wants to do their own thing and have a part of the GP interest, get access to deal flow, some direct investments, and basically that analyst that you think could be incredibly talented, but they just want to do their own thing. You saying, hey, the hard thing for you to do is going to be to raise that first 20 to 50 million. I got that covered, but I'm going to want to have a part of, it's going to have to be a business proposition for me. And again, that's more legal and negotiated terms, but you could do that, maybe 10 or 20 million with several. So another option that's not completely going off on your own, but being more engaged than just being an LP is to seed invest up and coming talent that, again, maybe your legal or accounting firm could introduce you, or maybe recruiters. I don't know. That could be an approach. What do you think of that?
Yeah, I think it makes a lot of sense. I'll spare the name, but we came across a guy that ran a business very, very well. And he ended up exiting for about 500 million, and it was really, really strong. And in essence, he was a CRO. And from a CRO type perspective, it made a lot of sense. And that's how we're building our structure isn't a traditional CRO type mentality, but from a business CRO type mentality where we're able to potentially leverage off somebody like him. And if you're able to go after individuals like that do have good deal flow or that are creating value, where you can offer some of the GP and you have your financial backers, I think that makes a lot of sense. And especially because they're coming in and they're lined up with you because they're placing capital in as well as just being general partner. I think collaborations on that end is extremely helpful, especially if you have name brand behind what you're doing, where they're allocating some of their name, which can attract some further LPs and solve some of those capitalization problems. I think that's a good model. And then also post actually investing inside of the fund itself. But again, answering some of those questions are how we're going to capitalize the portfolio companies. That makes a lot of sense also.
We hinted at it earlier from a bit of a different perspective, more so on hiring and outsourcing, non-US talent for a more cost-effective and possibly more opportunity. Let's dig into that a little deeper from another perspective, which in the past you think, well, we're just too small. We're not a VC firm with satellite offices and 50, 100, 200 people, but we do tend to think too insular here in the US. There's opportunity out there in all continents, but probably the one that I would focus the most on, it's a difficult one though, is Asia, Southeast Asia. They're ahead of us in certain things. We think that Silicon Valley or New York is it. We're completely dominant. We're dominant, but we definitely get competition from a tiny country like Israel, and for sure get it broadly from the region of Asia, even Southeast Asia. And think of the demographics in Southeast Asia. So I'm limiting it to Southeast Asia. What is it, like 3 billion people? North America, what do we have? 400 to 500 million. They have way more consumers. There is tremendous opportunity there. Does it come with more risk? I would assume so. But again, if you're a family looking to exploit inefficiencies, willing to have the guts and the commitment, build the right resources, I think there's opportunity.
Yeah, this is a great point. So there was one of the Harvard professors, I can't remember his last name, but Professor Bob. He did some really good analytics on what just happened in China, because what they just did in the last 50 years is remarkable, right? Where they had such high poverty level, and they were able to literally within a short amount of time flip that around in their advancements in tech and really going. And I'm not saying pro China, not pro China or anything like that. But I'm just saying, it was extremely impressive. Them setting that trend in that capabilities sparked a little bit of a question on our side, which is, okay, who's next? And one thing that we're looking at a lot right now is India. India is kind of modeling what just happened in China. And you have some really great, developments that are happening within the country itself. And then if you're looking at trends, if you're looking at an educational type capacity, what we used to see is you'd have people in some of these developing countries that were very motivated to get educated, which I'm a huge component of. I think self-education is extremely important, and being extremely active in education is great. And so their motivation factor in order to contribute to their households led them to really studying and getting a lot of in a lot of great colleges. And not just great colleges. If you look in terms of the education, the post graduate degrees, I think over 50% of them at one point were from foreign students, right? Trend-wise, what we used to see was post-graduation of some of these marquee schools were them staying in the United States, right? And looking for job opportunities here and really building out some of our advancements here. The interesting trend that we're starting to see is that whereas people were coming overseas to here and they were getting a lot of the advanced degrees over here and they were staying over here and they were creating a lot of power here, now they're starting to actually come over and get great educations where it still applies, but then go back home, right? That was a huge contribution, in my opinion, to really the rise of China and where they were at. And we're starting to see that exact same trend happening in India as well, where you're getting a lot of advanced degrees, they're going back, and then we're looking at it, okay, well, what's the trickle down effect on this? And if you look at some of their emerging markets and you're looking at some of their public offerings, we're forecasting that this is going to be definitely something of interest to really spark where we think it has a lot of access to grow. And then also in America, some of our portfolio, like one of our portfolio companies, we're looking at dual listing opportunities, right? If you're able to work and you're able to write an S1 and you're going straight to the NASDAQ, if you're able to dual list on like the Hong Kong exchange or an emerging exchange, that's taking place, whether it's in India or Singapore has got a really good exchange, you have to be that's an invite only, which we have a little bit of resources there as well. You're able to potentially build, again, some sort of model where you have emerging markets, you have great talent, you can access amazing people. It's definitely up and coming, and there's a lot of capital that's moving into those areas, which provides really good exit opportunities, both for things that are domiciled here and then opportunities that are actually foreign as well. So you're spot on.
Yeah, I mean, I've been pounding that for months. No one's listening, but
I'm listening. I've been looking.
But I'm trying. I'm trying.
You're dead right.
I completely agree with you about India. We didn't have time to get into, it's very tax nuanced, but the QSBS, I believe it is, about whether on a gain, or more importantly for companies you're investing in as US citizens in US companies, there are some tax advantages that you get tax credits on. And that applies to being an LP investor or being a direct investor. We did a podcast on it a couple of weeks ago. Go check that out. But that's a very intriguing thing that arguably makes it a little bit more attractive, although maybe on a smaller level. This has been a great discussion. We had to leave some things on the table. And again, I love the concept of it, but usually the majority of family offices are going to be better off being strategically an LP, and then maybe from there with their LP contacts doing some select one-offs. But there are going to be some families that are interested in, can we do this internally? I think we had a chance to cover some of those topics. I probably took a little bit of a conservative stance. Jeff actually a little bit more, well, it could be done. So hopefully you found it valuable. Jeff, why don't you give our audience a little bit of context, a little bit of color behind what you're doing in, like you said, precision healthcare, your work in VC, and how families may want to engage, whether it's potentially for deal flow, potentially to be an LP, maybe you do advice on creating internal VCs for families. I'll leave that up to you, but tell us a little bit about what you're up to and how people could reach out.
Guys, I absolutely love reciprocity. So anything that we can do to add value to you, please contact us. We're more than happy to help. If you guys want advice or you want access into some of the different databases that we're building or how we're going about it or what we're thinking about, we have no problem being an intellectual asset for you guys. We started off managing our own money. We started our own VC firm about 12 years ago-ish. And that has now evolved into us flipping the switch, and we started our own fund. We have something for us that's very important. We like to dream big, start small, move fast, and follow through. And so we're in that category right now where we're starting off small. We have about 4 years behind what we're doing. And we've gained some really good insight. We think that we're on the front of the precision-based healthcare. We're very, very focused, even though there's a lot of cool concepts that we're talking about. I think being very focused is pivotal. But if you think for any reason that we can be some sort of help to any of you guys, please feel free to reach out to myself or my business partner. Our website is infusion51a.com. So there's contact information there. Or if anybody has questions and want to contact Angelo, we'd be more than happy to speak with you guys.
And Jeff, for those live now, if you don't mind, and the company name, by the way, say the website again, and the 51 is the number 51, not letters spelled out. And Yep. It's okay if you want to give your email.
Yeah, my email, if anybody wants to email me, is jeff@infusion51a.com.
Excellent. Well, Jeff, it's been really a great pleasure. This was so insightful. I know we have plans to have you on in a couple of weeks. And then a couple of weeks after that, as we're doing a new series of investment opportunity, to have an audience listen in the evening relative to some tremendous opportunities in precision healthcare and some of the access that you have as well. So mainly more so for my live audience, stay tuned, lots more to follow. Everyone, I'm Angelo Robles. I'm the host of the Angelo Robles Podcast. I'm the founder and CEO at Family Office Association, a global membership organization dedicated to families of great wealth and their family offices, doing a tremendous amount of original proprietary content, hosting their daily digital programming like today and many other days for our members in sometimes select relationships, and privately consulting on creating or reinventing, especially during trying times, a family office. I'm very active on social media. We're Family Office on YouTube. Go and subscribe. And our website, which is now about 2 months old, but still relatively new, is familyofficeassociation.com. And I'm Angelo at familyofficeassociation.com. Jeff, thank you so much.
Thanks, guys. Appreciate your time.
Thank you.
Thanks, guys.